Filing for bankruptcy can be stressful for most. However, guess what? Considering you have no student loans, alimony, child support, and certain unpaid taxes, you now have a fresh start. Here are a few tips to help you get started. First, create a budget. If you follow these steps, creating a budget can be a straightforward and simple process. You want to A, determine your income. Start by figuring out how much money you earn each month from your job, any side hustles, or other sources of income. B, list your expenses. Write down all your monthly expenses, including rent or mortgage payments, utilities, transportation, food, entertainment, and any debt payments. Don't forget to include irregular expenses, such as car maintenance or insurance payments that you may not pay every month. C, categorize your expenses. Group your expenses into categories such as housing, transportation, food, and entertainment. This will help you see where your money is going and make it easier to identify areas where you may be able to cut back. D, set spending limits. For each category, determine how much you can afford to spend each month and set a limit. Make sure that your spending limits are realistic and that you have enough money left over each month to meet your other financial goals. E, review and adjust your budget regularly. Your expenses and income may change from month to month, so it's important to regularly review and adjust your budget to make sure it still reflects your current financial situation. Following these steps, you can create a budget that will help you manage your money and achieve your financial goal. There are many software tools available to help you create and manage a budget. Some of the most popular options include Mint, Personal Capital, YNAB, short for You Need a Budget, PocketSmith, and Excel or Google Sheets. Some of these programs have free features and trials. Others may offer different monthly plans to use the software. Second, start building an emergency fund. Starting an emergency fund can seem self-explanatory, just something you do. However, this can be one of those things that are easier said than done. If you follow these steps, building your fund can teach you so much about your finances. I call these steps the 6 S's. Set a goal, set a budget, start a savings account, start saving automatically, stay on track, monitor your account, stop, only use for emergencies. Set a goal. Decide how much money you want to have in your emergency fund. A common goal is to have enough money saved to cover 3 to 6 months of living expenses. B, set a budget. You have a head start here because we already created a budget. To summarize, take a look at your income and expenses to determine how much you can afford to set aside each month. It would be a good idea to reduce your spending on non-essential items to free up more money. C, set up a savings account. A good start would be a high-yield savings account at a reputable financial institution, or maybe you already have an account that is FDIC insured so that your money is protected and safe. You can also earn interest on some of your savings. It's important to note that interest rates can change frequently, so it's a good idea to compare rates and fees before opening an account. D, save automatically. Set up automatic transfers from your checking account to your savings account each pay period. This will help you stay consistent without having to think about it. Out of sight, out of mind. E, stay on track and monitor your account. Keep track of your emergency fund balance and adjust your deposits as needed. The goal is to reach your target emergency fund balance as soon as possible. And once you reach that goal, you may be able to relax a bit on the amount or keep it the same. Stop. Only use for emergencies. Try to only use the money in your emergency fund for actual emergencies such as job loss, unexpected major home repairs, car repairs, and medical emergencies. Building an emergency fund takes time, but remember, it's worth it to have a safety net for unexpected expenses. Number 3, pay all bills on time. Paying your bills on time is very important. This accounts for 35% of your credit score. Paying on time also keeps you from other unnecessary fees like late payment fees. Who wants those? Number 4, monitor your credit report. Check your credit report regularly to make sure it's accurate and to see what steps you need to take to improve your score. Credit monitoring companies offer services to help you keep track of your credit score and monitor changes to your report. Some credit monitoring companies offer these services for free, while others charge a fee. Number 5, consider getting a secured credit card. A secured credit card is a type of credit card that is backed by a cash deposit you make up front. The deposit acts as collateral for the card, which means that if you don't make your payments on time, the issuer can use a deposit to cover what you owe. The deposit is also typically equal to your credit limit, which means that the more you deposit, the more you can spend on your card. Secured cards are often used by people who are just starting to build their credit history or who have a poor credit score. They can help you establish positive credit history if you use them responsibly. This means paying your bills on time and not overspending. Over time, as you build a positive credit history, you may be able to transition to a traditional unsecured credit card. It's important to choose a secured credit card carefully, as some have high fees and interest rates. Look for a card with a low annual fee or no annual fee, reasonable interest rates, and a clear path to transitioning to an unsecured card. Also, make sure to read the fine print to understand all the fees and charges that come with the card. Overall, a secured credit card can be a good way to start or restart building your credit score and establishing good credit habits. Just be sure to choose a card wisely and use it responsibly. Number 6, consult a professional. A financial advisor is a professional who provides advice and guidance on managing money and making investment decisions. They help clients reach their financial goals by creating customized financial plans that take into account a person's financial situation, future goals, and their tolerance for risk. Financial advisors can help with a range of financial decisions. The tools mentioned can help anyone, whether you're just starting or repairing your credit history. Above all, just remember to keep building and moving forward. You got this. If you found this video helpful, please like, comment, share, and subscribe. Also, if you have any other tips, please share them with everyone in the comments section so that we can help each other. I really appreciate you for watching. Thank you so much. Until next time.